So this would be your second stage of reaccumulation and what ICT would call your silver bullet. This is ICT's favorite model. And the reason for that is the second stage of reaccumulation, you can see the price action that happened afterwards.
All right, folks, here we are on Trading Up. We've got Ali Khan in the house. We've just done an epic podcast. You've got to go and check it out. There will be a link under this, but don't go and click it yet because he's about to break down for you the market make it model he uses from his full mentorship that he took with ICT. He's been doing this for years. He's an expert, so you're about to be blown away. Welcome back to the show, Ali.
Yeah, thank you for having me here, brother. Hope you guys enjoy it.
Right, let's share your screen and get into it. Our sponsor, Blue Guardian, is the only prop firm that gives their traders a tool to protect them from hitting their max daily loss and overtrading. It's super simple to use. Just set the Guardian Protector each day from your dashboard. Did you also know that they've just released an unlimited time evaluation with a 0 trading days requirement, giving you plenty of time to hit their low 8 and 4% targets, making it super fast to get funded. Plus, it's cheaper than the 40-day time limit evaluation. Check out the link and coupon in the description to get 10% off your next Blue Guardian evaluation.
Thank you for that introduction, Cam. I hope you guys have enjoyed that podcast. If you haven't gone through it already, it's worth going through because you're going to understand what I'm about to show you here a lot better. So I'm going to try to keep it brief because if I really go into the technical details of the market maker model, this will be hours long. And I do have a course for that if you are interested. Selfish plug there. Anyway, we are here on the British pound. This is on the 5-minute time frame. And we're currently in live price action at the minute. So I've just pulled up this price chart and we'll quickly go through this now. So firstly, we are currently here trading in New York and I have delineated the day with Asia, London, and obviously the New York session. Now, one of the advantages of looking at New York is that we have London behind us. If we are to go higher, we will see the low form in London and New York will generally be a continuation of London, right? Now, what have we seen occur in London? Well, the day opened here at 12 a.m. New York time, and we consolidated, building a pool of liquidity above the market and below the market. At London Open at 2 a.m., the market drops lower, running the sell-side liquidity below this engineered consolidation and Asia's low over here, dipping into the premium end. So this blue line here is the premium high of a weekly fair value gap. So this is a higher time frame key level, right? We've dipped into that right in the heart of the London session. Now, smart money are pairing long positions with the sell stops below Asia's low and offsetting those longs back to the willing buyers above these relative equal highs up here. So there's going to be a big pool of buy-side liquidity in the form of buy stops above these relative equal highs. Now, this here is an initial consolidation, and then we drop lower to go back higher above the consolidation. So this is a market maker buy model. And you can see the same thing here in New York. We've consolidated and then we've dropped lower at the beginning of New York. So as New York opens at 7 a.m., we dropped lower and we've dropped into these consecutive down close candles. So this is our bullish order block. And this is important because these down close candles ran the sell side liquidity below this low first thing, and we've dipped into this higher time frame weekly fair value gap, right? This fair value gap that was left and we displaced higher, going back above the opening price of these two consecutive down close candles, validates this as an order block. What's also important here as well is that this order block was formed in the London session. So when we get to the New York session, we're going to look back and refer to the arrays inside of London, right? Now, again, similar to the London session, between London and New York, we have this period of consolidation. So we have these relative equal highs in the form of buy-side liquidity. So there will be buy stops resting above this area. And we have sell-side liquidity in the form of sell stops resting below these relative equal lows. Now, at 7 a.m., we dropped lower into this order block. And you can see how we've moved away. If we drop down into the 3-minute time frame, and we can get a little bit more detail about what's going on, right? Now, on the 3-minute time frame, you can see how we dropped into that higher time frame order block on the 5-minute time frame. We also have this low, high, lower low. So these two consecutive up close candles here is our breaker. So if we extend that across, we've got an overlapping here of PD arrays. Now, we've run the sell side liquidity below these relative equal lows. So the sell stops below these lows are now engaged. And again, smart money is pairing long positions with the sell stops to then offset them back to the buyers above these relative equal highs. Now, inside of this consolidation, we also have a smaller area of consolidation. So this area over here. Now, you want to look for something that is relatively equal in terms of the bodies, or you can look at the highs, right? So the bodies here are relatively equal, and I should probably do it like that. So that's the initial consolidation. We displace from the initial consolidation and then return back to it here. So if I take the low and I extend that across, the low over here comes in at 1.24050, and the high also comes in here at 1.24050. So that's perfect delivery of price. Now, it's going up to rebalancing some of this inefficiency. It doesn't need to rebalance the whole thing here, right? Leaving this left open will act as a breakaway gap. And this signifies that the algorithm is in a hurry to reprice lower. And you can really see when the New York session opens, how we really drop lower, clearing that sell side liquidity, right? Now, this is the sell side delivery of the market maker buy model. So we are going lower to go back higher again. And obviously, this is the buy side or the buy program inside of the market maker buy model to send price back higher again. So these sell programs and buy programs, they work inside of each other. They're constantly engineering liquidity on both sides of the market. And this is how smart money is able to pair orders, because they understand these buy and sell programs and these algorithmic footprints inside the market, right? Now, obviously, this gets a lot deeper. It can get incredibly intricate. But for the sake of time, I'm going to briefly go through the buy side of the curve, right? So if I take a line here and I delineate this lowest point, and anything to the left side here is a sell side of the market maker buy model, and anything to the right is the buy side of the market maker buy model, right? Now, we've left the initial consolidation here, and again, above that consolidation, we have a pool of buy side liquidity in the form of buy stops. In this case, since we have this high as well from a higher time frame consolidation, this is known as layered buy side liquidity. And these relative equal highs are going to house a big pool of buy-side liquidity above that, right? So the market essentially is running a sell program lower to clear the sell stops here. Smart money pairs those sell stops with buy orders and then offsets those at the willing buyers above the layered buy-side liquidity. This now gives us narrative, and it gives us a contextual bias of where the market is likely to draw to. Who's been making money over here? Well, the sellers have been making money. Where are their stops? They're going to be placed above here, because this is what the books teach us, right? Above the old highs. When we dip into this higher time frame level, which is our order block and our breaker, after the context of London posting that low and rejecting that higher time frame weekly fair value gap, the premium end, when price runs away back above the opening price of this candle here, we have another bullish order block. In this case, we've also seen a break in market structure as price has broken above this short-term swing high. We've retraced lower back into this buy-side imbalance. So over here, we've only got buy-side delivery, and the algorithm will seek this area to redeliver sell-side. Again, it's based on the market efficiency paradigm and the fair value parameters that it operates in. In this case, we didn't need to come down and fully rebalance, because if we extend this to the left, we can see that we had sell-side delivery pass through this range once, right? So this acts as a balanced price range, where we have sell-side delivery offered here with this candle going lower, and then buy-side delivery offered through that same range. So when price comes back down, this is a balanced price range, and we do not need to fully rebalance it again. Price touches it here and then really moves away. This drop lower into the order block and into this balanced price range, this could have been your second entry if you had got your first entry over here. But if you had missed this, then this could be your low risk buy Price then repels this area, displacing higher, leaving another inefficient area of price, right? So this here would be another buy-side imbalance, where we've only had buy-side delivery through that range. You can see the bodies of the candles here telling the story that it does not want to reprice any lower. We've dipped into this imbalance, and the premium end of the down close candles, which was our bullish order block, and we're finding support there. This area here would be our first stage of accumulation. Price then displaces higher and runs back lower into this buy-side imbalance again, which was left after price had displaced back through this range. Again, if we extend this out, you can see how we've had sell-side delivery here and then buy-side delivery through that range again. So again, this would act as a balanced price range, and we do not need for it to come back into these consecutive down close candles as an order block. Furthermore, we have these consecutive 3 up close candles, which would act as a breaker. We have our low, we have our high, and we have our lower low. So price is already inside of this bullish breaker. And we're already here looking for higher prices to go back above the laid buy-side liquidity, right? So this would be your second stage of reaccumulation and what ICT would call your silver bullet. This is ICT's favorite model. And the reason for that is the second stage of reaccumulation, you can see the price action that happened afterwards, right? It runs explosively through that layered buy-side liquidity and completing this market maker buy model. Now, if we run a fib from the high to the very low, and we grade that range in 4 equal quadrants, let me just get rid of this. You can see how that first fair value gap that wasn't fully rebalanced occurred at around the first 25%. I've done that the wrong way around, my apologies, but the first 25% is where we've seen this gap form. This is known as a breakaway gap because we did not fill this in and we ran away from that area, breaking back above this short-term high. So we do not expect price to come back down here and fill this area, right? Notice where the second gap has formed, which wasn't fully rebalanced, right at equilibrium of the expected terminus where the buy-side liquidity would rest above, right? So this is known as our measuring gap. Once this prints, if we take a fib and we measure the low to the actual high of that measuring gap, 1 standard deviation gives us the high over here. Also note that second stage of reaccumulation where it was occurring, below 50% of that expected terminus. So if this is the point of origin and this high is our terminus, we dip back below equilibrium of that expected terminus range. There are ways to calibrate your expected terminus, and there are ways to determine how high and how low buy or sell programs can go. And there are other measurements that you can do within price. But again, that gets very complicated and long-winded, and that's beyond the scope of this presentation at least. Based on what I've shown you here is really amplifying what I was speaking about in the actual podcast with Cam. The market runs on buy and sell programs, and these are algorithmic. Everything is measurable, and these footprints in price, they occur at specific areas and specific times. When you can combine these levels of price and time, then you can understand where the macros are going to form, which will instruct price to spool to either buy side or sell side liquidity above old highs and old lows, or rebalance inefficiencies in price, right? When we see price fail to fully rebalance an inefficiency and move away, that gives us insight into, number one, that the market is in a hurry to reprice higher or lower, and it also allows us to measure where we are inside of the buy and sell programs. This gets a whole lot deeper, and it can get a whole lot more precise. You do not need to know it in that kind of detail to make money in the markets, right? Like I said, I needed to know the underpinnings of how the markets were booking. And this is years and years of study and research of understanding and dissecting these market maker models and buy and sell programs. Now, if you can understand the basics of how market maker models work, you can make all the money that you need. But you have to have context and narrative behind why price is going to do what price is going to do. Without understanding context and narrative, you are just trading patterns. So, in the wise words of ICT, I hope you guys have found this insightful. I've tried to cram as much as I can into around a 10-minute video. And obviously, this gets a lot more detailed, but I am going to be doing more examples and further teachings and trying to really simplify ICT concepts. I have a few free courses planned for my YouTube channel, which is Ali_Khan_ICT. And I also am dropping daily gems and tips on my Twitter, which is again Ali_Khan_ICT. So if you are interested, please go and follow me. I'd like to say a huge thank you to Cam for having me on the show, and hopefully we can do this again. So yeah, take care, guys.
Folks, Black Bull Markets have 10 merch packs to give away to clients who sign up before the end of the year, including one of these trader keys. So to go in the draw, all you need to do is sign up with the link below this video or in the podcast description, and you'll go in the draw to win. It's that simple. And remember, folks, when you sign up to Black Bull Markets through the Trading Nut link below, you're going to get a 100% deposit bonus up to $1,000 on your first deposit. All you need to do is click the link in the description below the video or the podcast. All right, folks, there you have it. What a great breakdown there from Ali. Now, what is the best way for traders to get hold of you?
So they can get me on Twitter, Ali_Khan_ICT. They can get me on Instagram and on YouTube again, Ali_Khan_ICT. And then you can obviously from there, you've got the links to my socials for the Inner Circle Dragons or the ICT Academy. But there's a lot more content I upload on there, usually on a daily or weekly basis.
Brilliant. Well, I'll tell you what, folks, what we'll do is we'll put a link underneath this video here. Go and click it. All those links will be there for you to click on that page. So thank you once again for Ali for sharing with us today. Now, whilst you're down there clicking around, hit subscribe, like, and that notifications bell, and we'll see you in the next video.